Well, regular Insight viewers recognize her right away. She's a valuable resource in planning and sustaining our retirement. Heather Foster, investment advisor and fiduciary. We want to talk some more about the CARES Act. We talked yesterday about required minimum distributions and how those have been waived
for 2020. Yeah, so you don't have to take those out. Which that was a good thing because it actually will lower people's income, so maybe it's a better opportunity to do more Roth conversions for us because they don't have to not having to take the money out first. So, but the other thing I wanted to talk about was for those people that maybe are falling on hard times right now and they need to get into their retirement accounts. Generally not something we want to obviously tell people to do. These are savings that you've put away, but you know, we're in a situation right now where there's a lot of people with job losses, and even though that they're putting out stimulus packages and they've made the unemployment be able to last longer, and they're looking at adding a stipend to a government subsidy on an unemployment as well, if you have to get into your funds, they have waived the penalty if you're under the age of 59 and a half. So normally you can't touch your retirement accounts, your pre-tax side of it, basically 401ks, 403bs, all your employer plans, traditional IRAs. You can't touch those until you're 59 and a half. Without certain rules. There is a little bit of a rule called the Rule of 55 where you can, but aside from that, people who are in the younger generation can't get to their money without getting a penalty. So they've waived that penalty. You can take up to $100,000 out of your company programs without getting hit with the penalty. And the real thing here, which is not an April Fool's joke, is that they're going to allow you to, one, spread your tax liability over 3 years.
I was just going to ask if you're still paying taxes on it.
You will always pay tax on pre-tax money. Now, if you got after-tax money, that's a different thing. But if you got pre-tax money in your employer plans, which is the way most people have saved, you can get that money out. You can spread your tax liability over the next 3 years, and you will want to be strategic on how you do that. Maybe it does make sense to go ahead and pay all the taxes this year because maybe your income is lowered this year because you stopped working. So you want to be strategic with how you repay that. But then they also said, hey, you can also put the funds back in. Okay, so maybe you're taking them out, you need to use them right now. You've got 3 years to put the funds back in, and if you add the funds back in, then it's not taxable. So you took it out and you added it back in. You've got 3 years to add those funds back in. You would have to do an amended tax return if you don't get them back in the same year, because you're basically going to show a taxation and then you're going to show it going back in under this new rule where then you would not be taxed on it. They also changed where you guys can get loans out of your company plans. Normally it is 50% of your vested balance up to $50,000. They have doubled that. It's 100% of your vested balance or $100,000 that you can take as a loan. So you'll want to be strategic on understanding which way is the better way if you're needing to get to some of your retirement money right now to live off of, to pay bills. I know it's hard times right now for a lot of people. So you just want to make sure you've got advice on it before you do it. Understand the rules, the tax codes with it. We're kind of scrambling right now. A lot of your employers are working really hard. I've already got an email from my administrators on my company plan that are saying, hey, we're trying to work with these rules. You know, we've got to get them on file so that people can call into their company programs and basically get the money out, and they have to code them on the 1099 a certain way so that they don't get penalized the 10% penalty. But this is an opportunity to do that. This also, applies to people over the age of 59 and a half as well. So it's just it's a unique situation to spread your tax liability out. If you need to get to the funds, you got 3 years to put the money back in. Take advantage of it if you need to. Obviously, if you don't need to, don't, because this is your life savings we're talking about. But unfortunately, we're in a position right now where people are having to utilize these systems and that's what it was designed for. It was designed for those people that are affected by COVID-19, been diagnosed, and there are some parameters for the people that are supposed to use this kind of out to not paying that 10% penalty. They're supposed to have been diagnosed with it, taking care of a family member that has been diagnosed with it. Maybe they've had hours laid off, changed hours, furloughed, unemployment, having to stay home with your kids because your child care centers have closed. Those are all qualifying factors to be able to get to your money prior to the age of 59 and a half without the 10% penalty and be allowed to repay it within 3 years and or pay the taxes within 3 years. And it does not count against the 60-day rollover rule, which you're only allowed to normally do once a year. Any funds that are taken out this year that fall under this rule, you can put as much as you want back in whenever you want. You can take as much as you need out, up to $100,000 as many times. So you could take out $10,000 today and maybe you realize 3 months from now you need another 10,000. You can do it in multiple withdrawals.
Well, there are lots of rules, lots of things to know, which is why you should work with somebody, and you need to think about the tax implications too. So one more reason that you ought to have that holistic approach that we talked about before. So give Heather Foster a call today. Let her work through it with you. 234-2200.